Good afternoon. This is Gatwiri from COMTO National, Membership and Communications Manager. We have about 2 more minutes, so we're going to start in 2 minutes. We're just going to wait for some of our audience members to arrive. So until then, just kick back and we'll be with you shortly. Okay, we have about 1 more minute. We'll start shortly. Thank you for coming and being our guest today. All right, it's 2 o'clock Eastern time on the dot. We're going to start the webinar. Good afternoon and welcome to our webinar, Tax Implications of COVID-19 for Small Businesses. Before we begin, I'd like to thank our industry partners for their support of COMTO throughout the year. They are AECOM, HNTB, Jacobs, and WSP. Next, I have a few webinar housekeeping items to review. If you are experiencing any technical difficulties, please send a chat message to the host. To submit questions for the Q&A portion of the call, please use the Q&A box. Questions will be answered at the end of the presentation. This call is being recorded and will be made available to all attendees. And finally, thank you for joining us. I'd like to now introduce our presenters today from JT Goldstein. They are Maurice Tucker, who is an associate and an engagement lead, and Bill Henderson, a CPA and business advisor. So next, I'll hand it over to Maurice and Bill.
Good afternoon, everyone. And once again, thank you for having us and the ability to present our information in this forum. We know what the past year has been like for you as well as it has been for us. And we hope you've all been safe, your families are well, and that you continue to push through as we definitely continue to go through some unprecedented times, like none other we've experienced in our life. So I guess this is sort of our Halley's Comet in a way, but we just hope that all will remain well and that you all will continue to show your resolve to continue to see through as we just figure out our best ways to push forward and get back to what we once knew as normal. My name is Maurice Tucker. As mentioned by Gatwiri, I'm an experienced associate, been with the firm for 5 years. I work primarily on audits, business advisory, and consulting type engagements. And this is not my first rodeo in these presentations with you all. So I'm looking forward to giving you some information that will be useful. And we look forward to your input and any Q&A that you may have as we conclude. I'll pass it over to my colleague, Bill. Bill?
Thanks, Maurice. Hi, everyone. It's nice to meet you all virtually. Good afternoon. My name is Bill Henderson. I work with JT Goldstein in the tax department, specializing in tax matters. And for today's presentation, I'm going to be focusing on the business side of what we're going to be talking about. So with that being said, I'll toss it back to Maurice so we can get into this and get started.
Thank you, Bill. The first area we want to go through is if we can proceed with the slides. It's just to cover the topics that we want to discuss today and the related updates. The Families First Coronavirus Response Act, FFCRA, the Coronavirus Aid, Relief, and Economic Securities Act, CARES, and the Consolidated Appropriations Act of 2021, most recently passed the CAA. And what we're going to do is discuss some individual updates as it relates to your upcoming filings, and some things that have changed, or some additional things that we want to just make sure are brought to your attention, and also the business related provisions as well. I will start with individual, and Bill will proceed with the business provisions. Next slide. So individual provisions. Next slide. So the first thing we want to talk about was the recovery rebate, the individual rebate credit under the CARES Act, which you're allowed to obtain up for 2020, which was the sum of either $1,200 or $2,400 for individuals filing joint returns, and what's there for your qualifying child. The benefit overall was to decrease your liability if you have one dollar for dollar, or could be refunded to the extent that it exceeds that liability, or if there is no liability. The thing here was what was eligible, and if there were no, how do you quantify the eligibility? Basically, what it stated was the update with the economic income payments. You can qualify on your 2020 return if you did not receive your that stimulus payment, or if you only received partial payment. And if eligible for this credit for your 2020 return, it will be reduced by any economic impact payment that you receive. The other part is the income requirements. It didn't list them out here specifically, but it went to 150 for joint filers, where their phase out will start to begin. 112 file for head of household filers, 75,000 for individuals. The credits allowed for 2020 is refundable for the same year. And some instances, some may be able to get their advance, it may have already happened or earlier in this part of the year of 2021. So of course, the related strategy for this is just determining what your adjusted gross income is, any qualifying children you have, and your related filing status, and that should determine your rebate amount. Next slide, please. Next, we want to talk about some deductions. There were some updates to educator expenses. Not so much the dollar amount for educator expenses, which is still kind of baffling to me that it could still be as low as it is for educators. But it now allows you to include as part of educator expenses, PPE equipment, any disinfectant and other supplies used for the prevention of the spread of coronavirus. Obviously, we know why this was added with the pandemic. So they allowed this additional provision to add that, to be allowed for you to deduct that for any expenses that were paid or incurred during the year. The benefit of this is for any related purchases made to prevent that spread. As an educator, be it in your classroom or wherever, wherever facility in which you teach. The rules are that it's for eligible educators from kindergarten through 12th grade, be it as a teacher, an instructor, a counselor, principal, or aide, with a 900-hour school year requirement provided for elementary or secondary education as applicable to whatever particular state in which you teach. So this is deductible for 2020. You would determine your related expenses as an educator in support of that to be applied to your return as applicable. Next slide. Next deduction is the mortgage insurance premiums. So there's an itemized, this is an itemized deduction that would go on your Schedule A. You would claim it on that portion of your return, and for amounts that you paid or accrued in 2020. So basically, it's allowing you to treat those premiums paid for qualified mortgage insurance as home mortgage interest. Now, it must be in connection with a home acquisition debt, and the insurance contract must have been issued after 2006. This will expire, was previously accepted, expire at the end of 2020. It's now good through 2021. So what you want to do is just, as it applies to you, determine on your 1098 from your mortgage company or mortgage companies, because during the year, your mortgage company may have sold or assigned your mortgage to another company. You want to make sure you have the collective 1098s to represent all of what you paid for the year as you apply your deduction, seeing if it's applicable. So this will help you determine whether your Schedule A, as you add it to what you itemize, will be what you rather do, or if it exceeds the standard deduction. And part of this is just because of these mortgage insurance premiums are just saying, hey, what was the original down payment you made on the house? You might have had to pay that for an extended period of time and may not have built up enough for it to eventually go away. So just something to think about if it's applicable to you and as you analyze your 1098s from your mortgage companies. Next slide. Medical expenses, another deduction. So the 7.5% of the AG floor on medical expense deductions is made permanent. It previously increased to 10%. Now it's just being made permanent to 7.5. So the purpose of this, the benefit was to say, if they lower the threshold, this would allow more taxpayers to take advantage of this deduction for 2021 and years later, 2020. Think about this reasoning. The reasoning for this is for whomever may have been impacted by the coronavirus. We've seen hundreds of thousands of people hospitalized during the course of the year, incurring probably exorbitant amounts of medical expenses. Well, what will be some of their relief on some of these expenses that they are incurring? This may be some of that may be able to be applied to that. So the rules basically just cover payments for diagnosis, cure, mitigation, treatment, prevention of disease, or payments for treatments affecting any structure or part of the human body. Of course, that can cover the expenses related to that can cover a wide range of things. But some things that they say that they do not include, for example, are, as I just wanted to point out, funeral or burial expenses, non-prescription medications, or cosmetic surgery. So if you're at a particular age or stage in life and you feel the need to want to be beautiful again, you just won't be able to deduct that. And of course, the taxpayer can only include medical expenses that are paid during that year. This was made permanent as of the end of the year, and the way that you can test this applicability is on the irs.gov site. There is a can I deduct my medical and dental expenses tool that you can populate with your related expenses and just see how it may play out for you, or discuss with your advisor or prepare accordingly. Next slide. So now those are the deduction changes. Now some exclusions to also consider. These exclusions will be amounts that you can deduct from your return to give you some benefit of not including all of what you may have been compensated for during the course of the year. So the exclusion here talks about benefits provided to volunteer firefighters and emergency medical responders. So the exclusion for their income has been made permanent. Now, what is the benefit? If you were a volunteer firefighter, emergency medical responder, you're afforded this exclusion of income for the sacrifice made to provide their related services. Now, the rules are stipulating that you have to be a member of a qualified volunteer emergency response organization, and you can include that income of certain state or local government payments received and state or local tax relief provided on account of your volunteer services. Now, this was due to expire at the end of last year, but it has now been made permanent. So if this is applicable to you, if you volunteered any of your services, this is something you may want to look into and take advantage of. And the thing that I think about most with this was when the pandemic really first started and how New York City was the epicenter of the virus, the stress that it put on the existing staff there, they had to call in for anybody who else could help relieve them. And so this is one of those examples where you provided your emergency medical response to provide your services. Next slide, please. Another exclusion from income is the qualified principal residence. I have inclusion there, should say indebtedness, my apologies. Qualified principal residence indebtedness exclusion, or simply called discharge of qualified mortgage debt. So gross income under this IRS code will not include any amounts which would be includable in gross income if the indebtedness discharged is qualified principal residence indebtedness. So this is allowing taxpayers to exclude income from the discharge of debt on their principal residence. Now think about this. We haven't talked much about the housing market in at least in 2020 and how it's been playing itself out. I know that there's been a lot of sales. It's really been a seller's market as of late, but we know that there have been some issues with rent payments for certain people. And if there's rent payment issues, there's probably mortgage payment issues as well. And some people may have lost work or lost their ability to pay on their debt and eventually opted out of their homes and canceled the debt. And so what happens is what the service is saying, hey, you can exclude up to 2 million, 1 million for married individuals or individuals filing separately of discharge of debt income if it's qualified principal residence debt. This was due to expire at the end of last year, but the CARES Act made it permanent. It extends through the end of 2025, but it's going to lower the 2 million to 750 for married and 375 for those filing separately or individuals. This is something some may, find it may have been an unfortunate circumstance, but it's something that you may want to look into and apply it accordingly. So you would want to just look at your 1099-Cs as applicable that you should have received for 2020 and just determine how it's going to play itself out for you. Next slide. Some other things that were extended were some education provisions. We talk about tax excluded education payments by an employer temporarily includes student loan payments. So this added to the types of educational payments that were excluded to include these before the beginning of this year. It was $52.50 per employee was the limit for all of that. How this functioned, hey, employers basically, you get the benefit of what basically functions as a tax-free loan. The rules were the student loan payments had to be made by the employer, whether they paid it directly to the employee or the lender, principal and interest, but it had to be specifically for the employee, not your spouse or dependent. This was previously supposed to end at the end of 2020, but it was extended through 2025. So this was one we did bring up, I believe, before, but this one is going to be one that still applies. If it doesn't for you for this year, for last year, definitely take a look into it for this year and up to the 2025 end date. Next slide. Health coverages tax credit. So this is health insurance costs of eligible individuals. So the service is saying you can receive a tax credit to offset the cost of your monthly health insurance premiums if they qualify through the health coverages tax credit. So it's basically functions as a refundable credit. You get up to 72.5% of the cost of your health insurance premiums paid. And think about it this way. What they're really trying to accomplish here is just saying, hey, you may have been a person who worked, may have lost your work. It says here, it's for individuals and eligible for trade adjustment assistance due to a qualifying job loss. Think of it this way. We look at COMTO or, AMAX, you're in the transportation industry, and just think about the airport industry and how they were impacted during the year. This may be something that may be applicable to them or the people that work, that have experienced, worked in an industry where they experienced that loss. And if you received any trade adjustment assistance. It also speaks to individuals between 55 and 64 whose defined benefit pension plans were taken over by the Pension Benefit Guarantee Corporation. In contrast, those contribution plans, defined benefits may not have always been fully funded by those employers. And so this was why they were taken over, just to make sure that those benefits are intact and paid. This credit was due to expire at the end of last year. It's been extended to 2021. The approach here would be to assess the applicability to your circumstance and if eligible for that assistance per the aforementioned rules above. So a lot of things being put in place to try to, safe shoot wherever you may have experienced any kind of loss during the course of the year through your employment or what have you. Next slide, please. One thing that was also encouraged in this CARES Act and some of the updated language in these legislations passed was to encourage charitable giving. And one thing that was proposed was the above the line charitable deduction, which allowed you to continue to see how well you've done with your qualified charitable contributions, and if this is something that you were able to take advantage of, to also determine your applicability of it. It was supposed to have ended at the end of last year, but it was then extended through 2021 and increases deduction allowed on the joint return to $600. So, determine your applicable charities, donate up to the limit amount, and, your adjusted gross income will be reduced accordingly. And you can still claim a standard deduction, even if it doesn't exceed what typically would be on your Schedule A when you itemize. Because charitable giving usually is part of itemizing, but they're allowing you to have the benefit of this in addition to that. Next slide. Also was updated and was also extended was charitable giving, the modification of limitations on individual cash charitable contributions. So under the pre-act law, you could do up to 60%, but now they're saying, hey, it's been disregarded and you can carry on in excess up to 100% of your AGI for 2020. So it's again giving you the benefit of looking into, what your charitable giving looks like and giving you a chance to exercise giving more and also still receiving that additional tax benefit. It was previously supposed to end at the end of last year. Now it's extended through the end of 2021 this year. And you think about this, the big thing when the Tax Cuts Jobs Act law passed, we looked at itemizing versus standard deductions. And it almost seemed like, you thought that with the standard deductions being increased, it almost kind of discouraged what you might be able to do if you itemize, because if it didn't exceed that, and you wouldn't really get a deduction for it anyway. So now it's just trying to just give people a chance to look into that and just, assessing their tax situation. Next slide. These next two slides are just going to be dealing with and talking about energy credits. Depending on what you may do with your home, there's some things that you may want to take advantage of if you can, in terms of what would be applicable to looking into how you're conserving or trying to use energy within your home. So this is a credit that's available for qualifying energy improvements to a taxpayer's home. And the period for which this was applicable to was property placed in service after December 31, 2007 and before January 1, 2009. What the best thing you want to do is, look at what you may have done. I don't know if it could be something you may have done with your windows, with your roof, solar paneling, any of those types of things to figure out what you put into that on your principal residence, and just seeing if that's something that you would qualify for with the deduction. Next slide. The next one is just kind of going into some more in-depthness of these residential energy efficient property credits. So this is a credit for percentages of expenditures for qualified solar electric property, solar water heating property, qualified fuel cell property. I mean, some of this stuff is really very specific. Small wind energy property, even geothermal heat pump property. Now, where this is applicable is for expenditures that you've made for qualified energy property installed on or in connection with dwelling units in the United States that are owned by the taxpayer as their principal residence and originally placed in service by the taxpayer. So it's pretty specific, but it goes in, again, it really just goes into whatever you might have done or looking to do in your home, and how that you can perhaps benefit from the cost of doing that. This was supposed to end at the end of this year, with a phase down of the credit during 2020 and 2021, but now the phase down period was extended for 2 years through the end of 2023. This is probably something that's going to continue to evolve. When you consider what people are doing with their homes, you know, energy conservation and things of that nature, these are going to be some ever evolving things. And for those of you in certain homes and properties that may have been recently built, or you know, that you can make these kind of improvements to or modifications to, these may be some things that you want to consider and just seriously look into to see if it will be of some benefit to you, for not only just for your residents, but also from a tax standpoint. So we just suggest that you organize any related expenses associated with that and determine their applicability accordingly. That is all that we have in the updates as relates to the individual updates. From here, we'll switch over to Bill. And Bill, you can, as we get into the next slides, you can go into the business provisions.
Thanks, Maurice. So yeah, like he said, I'm going to be covering kind of the business and employer provisions of these acts that we're talking about today. And I think where I would start is just kind of going back to where we started this presentation, right? So there's 3 acts that we're really going to be concerned with. And if we get into this next slide, what we're going to start with is the FFCRA. Now, if you remember right, the FFCRA and the CARES Act are actually the earliest kind of coronavirus responses that the government had. So these 2 acts are coming up on, you know, almost close to a year old at this point. Some of you may even have been on a webinar we gave for COMTO last year where we kind of introduced these 2 pieces of legislation. Now, at that point, obviously, we kind of had no idea where this was going to take us. But at this point, we have a better idea of what CARES and what FFCRA look like in terms of for business taxpayers. So the key thing to understand about those 2 acts now really is the way in which the CAA, which is the most recent act passed in December, how that affected them, because it changed a lot of provisions and it also extended a lot of provisions. So starting off, we're going to talk about the paid sick and family leave. So under the original FFCRA, it required covered employers to provide 2 weeks of paid sick leave and up to an additional 10 weeks of expanded family and medical leave to employees, which is funded by tax credits. Now, it only applied to certain employers. It was mostly targeted toward kind of smaller or middle range employers, less than 500 employees. I've included a link there because the guidance in terms of who is covered and who is not can be a little bit complicated, but that's a very helpful link in terms of trying to determine whether this is something that applies to your business. But so going back to where I started, the key thing here is that the CAA has extended this provision. It originally was supposed to expire at the end of 2020. It's now going to be extended through the end of this month, March 2021. Now, if we go into this next slide, what this paid sick and family leave provision was supposed to do was effectively, if you have an employee that's, you know, subject to a quarantine order and can't come to work, or thinks they might be testing positive for COVID and they need to seek medical advice, there's all sorts of a list of basically qualifications where if you are a covered employee or a covered employer, you can get a dollar for dollar reimbursement through tax credits for any wages or health insurance coverage you have to pay to your employees if they have to take this kind of leave. So obviously, like I just said a second ago, the mandatory portion of this expired at the end of December. But the option for employers is still there through the end of this month. Obviously, we're trying to get through this kind of coronavirus period. We're deep into vaccines at this point. But if you still have employees who think they have been exposed or need to take time off for medical treatment or advice or anything related to COVID, just know that this is the kind of flexible option you have as an employer to cover your costs if you have employees that can't come to work. Next slide, please. So another kind of important provision that we saw with this new CAA and this notice that was released by the IRS is that certain self-employed individuals can now also qualify for some of this sick and family leave that was previously only available to employees. So who's covered by that? If you're a self-employed individual and you would otherwise be covered, like basically if you were an employee, then chances are you're going to be covered as a self-employed individual. Same situation here as relates to self-employed individuals. The CAA extended this again through March 31st, 2021, which is the end of this month. So self-employed individuals as well. If you have to miss time to something COVID or government mandated related to COVID and you can't work, talk to your accountant. They might be able to get sick leave even as a self-employed individual. Next slide, please. The next thing we're going to talk about, continuing the self-employed individual. So another important thing to kind of talk about with self-employed individuals is that there's a new they fixed a problem they used to have really, which is that last year they wanted self-employed individuals to calculate their credit based on the same period that the self-employed individuals were saying that they can't work, which doesn't make a whole lot of sense, right? Obviously. So what they fixed this year with the IRS's new notice is that the taxpayer has an option of which year's net income they're going to use for purposes of kind of calculating what kind of sick leave credit they may be entitled to. So that's just kind of another fix they did for self-employed individuals, because early on, self-employed individuals didn't really get maybe the same support as some employees did. But now self-employed individuals have a lot more options at their disposal. So if you are self-employed, again, you have any kind of sick leave problems that you run into, definitely talk to your accountant. You might be able to take this credit in your tax return. Next slide, please. Employee retention credit. So this was originally something that came to us via the CARES Act, but again, has been modified by the CAA. So the CAA 2021, what that basically did was the original CARES employee retention credit provided a refundable payroll tax credit for 50% of the wages paid by employers, subject to certain caps and limits. Now, what this new CAA Act did is that it extended the eligibility period, this time through June of 2021, and it increased the applicable credit percentage to 70% for quarters beginning after December 31st, 2020. So what that means is originally, another important part of this is that there was a problem originally where anyone who took a PPP loan was not going to be eligible for this employee retention credit. The CAA 2021, again, has fixed that loophole. So what that means is that you can take both, but the important thing is that you can't double dip. Now, what is double dipping here? Double dipping would be receiving a PPP loan, paying employee wages with that loan, and then trying to also take the employee retention credit as part of the PPP loan payments, which you cannot do. But what you can do now is that if you receive a PPP loan, you can pay one employee with PPP loan, and you can take an employee retention credit for a different employee. And that way you can cover both your employees if, for example, you don't receive enough PPP loans to cover all of your employees. Next slide, please. So employee retention credit was really supposed to be focused on businesses that experience a significant decline in receipts, or who, for example, the government shut down all of your business because of quarantines or other related orders. So what you're looking at for eligibility there is really, are your receipts in a given quarter 80% less than they were in the same quarter of the prior year? If it is, again, 70% of the wages paid now after the CAA are potentially available to be credited when it comes to tax time. The maximum amount for qualified wages is $10,000 per employee per quarter. So the maximum credit for qualified wages is either $5,000 or $7,000 per employee per quarter. The employee retention credit, no doubt, it has complex rules. So this is definitely one where you're going to want to coordinate with your accountant and with your payroll service provider. You know, use all the applicable forms you need, make sure record keeping is on point and kind of sharp. But you can definitely take advantage of this credit if you kind of mind what you need to mind in that respect. Next slide, please. Another big thing, obviously, Paycheck Protection Program, Paycheck Protection loans have been huge. The old rule, which this is before the CAA, was that if you had a PPP loan that was canceled, that was likely going to be income to you as a taxpayer. This is something that they fixed. They were obviously aware early on this was going to be a big problem if they didn't get their hands around it. So now PPP loans that are forgiven are not included in income if there are three things that are met. First off, if the employee and compensation levels are maintained the way they're required to for the loan. 2, if the loan proceeds are spent on payroll or other eligible expenses. And 3, if at least 60% of those PPP loans were spent on payroll. So how do you apply for this PPP forgiveness, right? Basically, what you're going to want to do is you're going to want to contact the lender that got you the PPP loan. You're going to want to compile your documentation, both payroll and non-payroll related expenses. And you're going to want to submit those forms and the documentation from the lenders. And then that kind of gets the process rolling. So what's the benefit? The benefit of that is that basically the PPP loan that's forgiven is going to become tax-free income. The only kind of caveat to that is that you just have to keep spending any remaining amounts in accordance with the terms of the original PPP loan. So how do you do that? It's basically just an exercise in following the rules and making sure you keep up with the requirements. Whatever your PPP forms say you need to do, you just need to make sure you're on top of that kind of stuff. So in terms of strategy there, it's really just a compliance issue. Make sure you're doing what you need to do, and you can definitely take advantage of PPP loan forgiveness. Next slide, please. What are the tax consequences? Let's say basically you actually get a PPP loan forgiven. What does that look like? So if you're a recipient of a PPP loan and your business is either a partnership or an S corporation, any amounts that you receive as a PPP loan that's excluded from income is going to be considered tax exempt income under IRC sections 705 and 1366, which is the Internal Revenue Code. So what does that actually mean? Well, what that means is that basically a partner share of deductions from costs giving rise to loan forgiveness increase the partner's adjusted basis in their partnership, which could potentially be important if you're in a position where you want to sell your business some point down the future. So that's something that won't really have a consequence this year for you, but it's something that as a business owner, you need to be mindful of what's your basis in your business. Another important thing to kind of keep track of here is that you don't want to forget about state taxes. So this PPP loan forgiveness is huge, and I think it's going to be a great provision for a lot of people who accepted PPP loans. But I think we also need to make sure that people remember, if you own a business, that states are not necessarily following the federal rules with this. There aren't state uniform rules to how you treat forgiven PPP loans. Some states have decided they're not going to be taxable. I believe some are still up in the air. So that's something where you're going to want to kind of circle back with your accountant or whoever prepares your taxes to make sure that you have your eye on the ball in terms of, forgiving PPP loans and what that might mean on the state tax side, not just for your federal taxes. Next slide, please. We also had this executive order on payroll tax deferrals. Now, this might not be something that is applicable to a lot of businesses because it seems like this is a provision that was mostly targeted toward very large companies. But this was basically an executive order under the previous presidential administration, which basically said that the due date for withholding of any employee, payroll taxes, basically the 6.2% during the period September to December of 2020 was postponed. And the result of that was that affected taxpayers could withhold and pay applicable taxes that they were deferred ratably from wages and compensation between January 2021 and December 2021. And then interest on that begins to accrue starting January 1st, 2022. So this, again, is something that, based on what we've seen, I haven't witnessed a tremendous amount of this being taken advantage of from smaller businesses. I really think that from my perspective, it's something that's more been angled toward businesses with a very large number of employees. But this is just something you want to keep in mind at this point. And this is something you want to communicate with your employees about too, because you want to make sure that, if you're deciding to withhold the payment of the employee payroll tax or the collection of it, you're kind of talking to your employees so they're not going to wind up with a large bill at any point down the line. Next slide, please. Another provision that was changed as a result of these kind of legislative things was the corporate minimum tax credit, which was accelerated. The minimum tax credit was refundable for 2018, 2019, and 2020 at 50%. It's actually going to be refundable at 100% for 2021. And sorry, that was the old law. I apologize. So, according to the new law, it's also going to be 100% refundable in 2019. And that's something that could be potentially important because that could be refundable cash to you if you have a C corporation. And obviously we know that COVID's placed a lot of strain on, a lot of the cash operations of businesses, cash flow. So that's another thing where, if you kind of get with your accountant, make sure he understands what you're looking to do. It's definitely a position where there's an options to take advantage of here, but it can be, a credit that definitely requires some homework and some record keeping on the part of the taxpayer, but just something to keep in mind when filing season comes around. Next slide, please. So now I think as we get towards the end of what I'm going to talk about today, it's really just a wrap up of some miscellaneous business provisions. These are things that, they're not kind of the major piece of the legislation that we talked about. These aren't kind of giant things that affect all taxpayers. But what we do have is a lot of different business provisions that were either tweaked a little bit or that are going to wind up getting extended. So for example, the one that's probably been in the news the most is the deduction of business meals. So for expenses either paid or incurred between January 1st, 2021 and January 1st, 2023, food and beverages provided by restaurants for business purposes are 100% deductible as opposed to 50% in the past. This is sometimes referred to in the news as the 3 martini deduction, maybe a little bit, derogatorily. But if you are, if you're someone who travels a lot for work and you have to eat a lot on the road, this is definitely something that's going to be not insignificant. I mean, this is something that could potentially be important, especially if you're like I said, a small business owner where you have employees that need to travel a lot, all that kind of stuff. This is definitely something where if you're in that kind of business, it's going to be a big bonus going forward for sure. The railroad track maintenance credit. This is another thing that we previously contemplated, but has now been made permanent by the 2021 CAA. So it's 50% for taxable years beginning before January 1st, 2023, and it's subsequently 40%. Again, obviously, that's a little bit of a niche credit. Not that many businesses are necessarily in the line of work of maintaining railroad tracks, but if you are, it's something you need to be aware of. So this is going to be something that's going to be sticking around for a while, for at least 40%. So that's definitely a big provision if you're in that industry. Another thing that we've seen is the 7-year recovery period for motorsports entertainment complexes. Again, pretty niche, but if you are, in that kind of business, this is the kind of thing where to 95% of taxpayers, it's probably something that they'll never have to think about in their life. But if you're in that, in that industry, it's certainly going to be important. So that's another thing you kind of want to keep in mind as you go into filing season this year. Next slide, please. And again, this is kind of some of the smaller stuff, the kind of thing that you might get an email about, but we just kind of want to put in your face again to kind of remind you. Again, more really niche stuff. It's similar, I would describe it to of what Maurice talked about with kind of like the home energy provisions on the individual side. Not everyone is necessarily doing a whole lot of stuff to their home on energy efficiency stuff. But if you are in that position, it's just one of those things you want to make sure there's stuff that can be done here. So it's another thing where I think it's just important. It shows kind of how important it is to have open communication with whoever your accountant is, or whoever's going to be preparing your taxes, because this isn't something that is on the front of everyone's mind when it comes to tax season. We're not necessarily thinking about, as you see on the screen, credits for qualified fuel cell vehicles or alternative fuel refueling property or 2-wheeled plug-in electric vehicles. But this is one of those things where there's all sorts of kind of little tax provisions here and there that you just need to know apply to you in order to really take advantage of. So again, I think the key really, and I think a good thing to wrap up on as far as my slides go, is that a lot of this stuff is very complicated. It's very in the weeds. It's very, there's complicated rules. There's all sorts of qualifications, but it's the kind of thing that can definitely be very important as a business to take advantage of. So if you keep open communication with your accountant, you can really get some very strong benefits from some of these kind of unique or more bizarre even tax provisions. So I think that just about wraps up my slides for the business provisions of COVID-19 update. So I think what I'm going to do now briefly is toss the webinar back to Goodweary, and then we can kind of have her read out if we have any chat box questions or any comments from the audience or any like that people would like to get some clarification on. So Gary, I'll go back to you. Thank you.
Okay, we have a question. We have one question so far in the Q&A box. So if you have some questions, remember to use the Q&A box to ask them to Bill and Maurice. So the first question was from Anonymous. It says, I was told that the latest CARES Act funding and COVID relief packages extended payroll tax credit for employers up to 500 employees. Just to be clear, I am not talking about the FFCRA tax credits for payroll under paid sick leave. There was another credit that did not previously apply to us, where small businesses got payroll tax credits for keeping people employed and working. Is this such a thing?
Yeah, so I think I'll take that one because that sounds like it's a business tax credit. I think it sounds like, and I hope I answered this at least partially during the webinar, but I think it sounds like what you're referring to based on that question is the employee retention credit. So I don't know if Goldstein wants to scroll back to some of those slides, but that's, I think, the one that you're thinking of. So basically, just to run that back again, that's kind of a credit for, wages that were paid for you as an employer. So, if you had to make a payment to an employee because, it's basically just a provision that's made to keep people from firing people in this kind of environment, frankly. So I think that's the credit that you're thinking of. And that's one that's not under the sick leave. It's purely based on what wages you paid to your employee. And that's also the one where now the change from CAA is that you can also receive a PPP loan and still claim that employee retention credit, as long as you're not using both for the same employee, if that makes sense.
Okay, so Anonymous, let us know if we did answer your question in the Q&A box. So we have another question from Joanne Brooks. I was told that you could take money out of a 401k and spread the taxes and capital gains impact over 3 years. Is that true?
I'm not sure about the applicability of the 3 years, but you are able to take out up to a certain amount without penalty. You were also allowed to do an additional 10% and also not be subject to the penalty. So you wouldn't have to worry about any applicable, the additional tax or anything associated with that. So that was one thing that we did mention that was available to be taken advantage of during 2020.
Okay, and Maurice, we had a question earlier from, I think it was Felicia, about the, can you go back to that?
Yes.
1.5%.
Is it the slide itself or was it just the question? I think her question was, what does that mean? The medical expenses incurred over the 7.5% are deductions on the entire amount. I mean, just to clarify, the level or the floor of 7.5% means that you can deduct qualified medical expenses that exceed 7.5% of your adjusted gross income. So how you want to approach that is you look at what your adjusted gross income calculates on your return. And this is probably something you'll be going over with your accountant. And then you apply what your medical expenses were that you want to deduct. And the tax program will usually calculate what that amount will be in excess of that 7.5% and kind of just give you what the answer is from there.
I could also just provide kind of a quick example for that. So if you were to think really roughly, just making up numbers, let's say, for example, your adjusted gross income is $100,000. So that would mean 7.5% of that would be $7,500. Right. What that floor means is that any amounts you spend over $7,500 that year would be deductible for purposes of that, for that provision.
Okay, it looks like we have, Anonymous said thank you that you did answer their question.
Great.
Right now we have no questions. I'm going to give it just a few seconds.
I did see one more. I'm sorry, Katuri. There was a question about what is the amount of the residential energy tax credits. And basically, the answer to that was you can take up to 20% of your related costs. And that's all those things that are applicable in the benefits outlined that we had in that slide. So it's up to 20% of those related costs, whatever, what those may be. Also, another thing was the credit for the amount for the cost paid for qualified fuel cell property is limited to $500 for each 1/2 kilowatt capacity of the property. I don't really know how they measure these amounts, but they're credits that you can consider and just see if these are things that may be of benefit to you if you've had those types of expenses. And they're credits, so they reduce whatever your liability might be, dollar for dollar.
So I don't see any more questions in the Q&A box, and I don't see any questions in the chat. That being said, Bill and Maurice, did you want to give any closing remarks?
Just that, the tax season, the deadline is April 15th. And you can correct me if there's been any updates, Bill. But I know last year we were looking for some guidance on what extensions would be out there and what have you. And we know last year what was extended to July and then to October. Everything's kind of to normal with the filing season for now, unless something else comes up, which we doubt that will probably happen at this point. So you're filing, your individuals are, April 15th, the extensions are good through October, and all the other related business deadlines are still in effect. We know that this may be an interesting season for you all, so, really be judicious with your information and your inquiries with your advisors or preparers to just be sure that all of your bases is covered and just making sure that you look into taking advantage of anything that you see that is or was and has been and even will be applicable to you, if not for the end of 2020, definitely going forward as well.
It looks like we have one more question. Will the presentation be available to us after the webinar? We're definitely sending out the recording. So I'll leave that question to Bill and Maurice. Will the presentation be available?
Sure.
Yeah, we didn't have an issue with that before. So
Okay. Yes. So the question is yes. I will send out an email to all of the attendees with the presentation as well as the link to the recording.
Yeah, I'm just glad we had some questions and we just were able to answer. So we welcome that, and we appreciate those sticking around and really ask us things. So we appreciate that.
All right. Well, Bill, if you don't have it, do you have anything to add, or I can go to the closing?
I think Maurice just about covered it. I mean, it's a tough time, obviously, like without saying, all this stuff is really complicated. It's just, try to keep those lines of communication open, and we'll all get through it as best we can.
I will say one more thing, and this may be counterintuitive to us as accountants and tax preparers. Take your time, consider the deadlines, but don't be rushed or, hectic or helter-skelter with getting these things prepared, unless you know the simplicity of your situation. But if you're really being researched and really want to be considerate of, what these changes and what these laws and impact may have on you, take it, get your questions answered even further at your local level, and just find out what really is going to be applicable to you. Now, if you can find all of that stuff out within the next 30 days or by April 15th, by all means, then get your things filed. But we know that there is some challenges with some people being able to figure out everything that's applicable to them. And we never want to make people feel rushed into getting a filing complete. Of course, there's always extensions. The only risk in that is, hey, if you wind up owing, there just may be some interest that may be accrued for you for that period. But it's always better to be safe and be researched than to just helter-skelterly file a return. And I don't even go so far to just say that, or just file a return where you're not sure if you could have had taken advantage of some additional things that might have been of benefit to you. So some of this stuff is researched, and some of it may be real specific, but you just never know what's applicable to you. So in these curious times and the way things are going, and with these legislations passing and different things popping up every day, take your time and be judicious in your information and preparing and getting your returns prepared and filed.
All right, thank you. So with that, I'd like to thank Bill and Maurice for their time and helping us with this presentation. And I'd like to thank our audience for attending and also their questions. Before we leave, I just wanted to let you know about a few more upcoming webinars that COMTO has scheduled. On Thursday, we have our Women's History Month program, Women Leaders in Transportation, Breaking Barriers and Making Lasting Change. It will be moderated by Carmen Garcia, who is one of our COMTO National Board members, and we will have 5 women panelists from transit agencies around the country. And then on March 25th, we'll have part 2 of our COMTO 50 Historical Perspectives. That's where we will sit down with our COMTO leaders, past and present, to get their perspective on COMTO turning 50 and the history of the organization. Then on April 14th, we have a webinar with emerging leaders, work-life balance during COVID-19. And then we also have our 50 for 50 campaign, where we're asking our COMTO members and supporters to donate $50 to the organization in honor of our 50th anniversary. With your donation, you will get a COMTO 50 branded mask. So you can go to comtonational.org to place your donation. And then if you have any questions, or you want to know more information about COMTO, such as our events calendar, our 50 for 50 campaign, and of course, becoming a member, visit comtonational.org. With that, we will go, and we ask you that you have a great afternoon. And once again, we'll be sending the presentation and recording to you shortly. Thank you. Have a good afternoon.
Thank you.
Take care, everyone.